Alrighty then. This video is going to have to do with the construction of a multi-step income statement. It's a special income statement for companies that have a product, buy low, sell high. Okay, and there are multiple steps at arriving at the final Jeopardy answer. There's a bunch of subtotals along the way. And what is the final Jeopardy answer? Well, it's the same thing we had way back in the wonderful world of Jill Jones, yeah? Net income or net loss will be the bottom line, the proverbial bottom line. All right, so let's look at this thing. Is it going to have a heading? Of course it's going to have a heading, right? Name of the company, what is it? It's an income statement. Do you have to put multi-step? No, you don't have to. It's understood when you look at how it's constructed. All right, so the first section, revenue from sales. These are our new friends. Now this company, XYZ, used the periodic inventory system. So let's just keep that in mind as we go to the second section. So this is our revenue account, $2.2 million in sales. And then maybe we shipped some pink wing nuts and they were supposed to be blue. So we had a bunch of sales returns. And then we had sales discounts, which we gave to customers for paying rapidly, let's say within 10 days. Okay. So you add these together, 46,000, and subtract from your gross sale amount to get at a world famous subtotal known as net sales. Okay. Now, regardless whether you're using periodic or perpetual system, this area would basically look the same. And the second section would not look the same. Again, this is the periodic system. So, the second section is the cost of goods sold section. And we started the year with $275,000 worth of merchandise. During the year, we bought a whole bunch more. That's that account we used when we bought merchandise, purchases. We reduced the purchases by stuff that was returned and discounts that were taken. So the total adds $25,000. We take the $765, which is our purchase amount, deduct the $25,000 for returns and discounts. We get to a number, net purchases. Are we done yet? Almost. The cost of bringing the merchandise to our place of business, which we collect in an account called Freight In, yeah? We'll add that to our net purchase amount. And we get this number, $746,800, which is the sum of the net purchases and the freight in, $746,800. So how do you get to this number? Well, it's comprised of four different numbers. Your gross amount of your purchases, your returns, your discounts, and your freight, $746,800. Now, we did the inventory example with the sneakers. When we started the year, we had $10,000 worth of sneakers, and then we bought $80,000. Well, that was pretty simple, right? Well, it's a little bit more complicated, but we get to the same number. What number, you say? We get to the cost of goods available for sale. When you add what you started with to what you bought, you get what is available. Did you sell everything? No, of course not. So you had inventory at the end of the year, counted, let's say, $280,000 worth. Now the cost of the goods sold, or possibly disappearing for some other reason, is $741,800. Take your available, subtract what you didn't sell, and your COGS, well, that's the number you did sell. And as I mentioned in the earlier video, this number could include the cost of goods which have possibly been shoplifted or otherwise stolen. So it's not a real strong system. Anyway, so now we got this, we have one subtotal, which is our net sales. The COGS number, cost of goods sold, that's what we sold it for. And the gross profit, another, these are world famous subtotals, right? Cost of goods sold, gross profit. These three numbers go together. 2154. What you sold it for, 741. What it cost you, 1412. That's your gross profit. Okay. But you, of course, realize there's a whole bunch of other costs that have not been accounted for yet, otherwise known as operating expenses. So there's our number. Now, what kind of expenses did we have? Well, typically the expenses, not always, but typically they're grouped as selling expenses and general and administrative expenses. So what's a selling expense? Of course, that's going to have something to do with the selling, directly or indirectly related to the selling effort. So I put down a bunch of examples here. Advertising and promotions, right? A salesperson's salaries, marketing expenses, commissions paid to salespeople. Now, a lot of expenses, you could have travel and entertainment that was money spent by a salesperson, but you could also have travel and entertainment for monies spent by, let's say, some type of administrative person. All right. And some expenses would have to be allocated. Like you might have a building, and a portion of the building, let's say the first floor of the building is a store. Well, the expenses relative to the first floor would be selling expenses, but if the second story was administrative offices for the company, then you could categorize that as office or general and administrative. So there's a few of these that might be allocated. And so anything having to do with the store is typically going to be a selling. And here's one of our new friends, right? The freight out. What's that? That's the cost of shipping goods to your customers. Freight out, included in the selling expense. Okay. So the total's $469,000 for all these expenses. Okay. Now, general and administrative. These are support functions of the company. Yeah. So we're not involved with the selling effort, but we are involved with the operation of the company. And I just put a few examples here. Anything having to do with office, general, or administrative would fall into this section, including possibly costs which had to be allocated, like these three. Okay. What's the total? $517,000. So we have grouped together our expenses into these categories, which are typical but not set in stone. And what do these two numbers add up to? What's 469 and 517 equal? 986,000. Operating expenses. All right, let's go back. What was our gross profit? 1412,200. If you take 1412,200 and you subtract 986, what do we get? We get another subtotal. $426,200, otherwise known as operating income or income from operations. This is a very important number for our company, because this is our mainstream activity. This is what we're in business for. We're selling wing nuts, say, perhaps, right? And we have earnings of $426,000 related to our primary business. And these activities here that included in sales and operating expenses are going to continue one year after the other, right? So we're hoping against hope that this is a positive number, yeah, which it is. It's our mainstream activity. Okay. But there are certain other items that might show up on our income statement that some call non-operating. We're going to call them other income and expenses. Okay. These are incidental to our business. They don't have to do with our mainstream activity. What's our mainstream activity? We're selling wing nuts. But we got some extra space, which we rent out. So we got a little bit of rental income. We're not a real estate company, okay? But we do have some rental income that clearly go in this category. We have some interest expense, which would be a financing cost, okay? So if we take our operating income, add in our rental income, subtract out our interest expense, we get to the final Jeopardy answer, which is what? Our net income. Well, what's missing here is the taxes. So in our first semester here, we're dealing with sole proprietorships, yeah? So XYZ company is owned by a person who's treating it as a sole proprietorship, and the taxes that will be paid are paid on the personal tax return of the owner of XYZ. So it's part of their personal income tax return, Form 1040 at the end of the year. So what else can we find down here in this other income and expense category? Put a few more examples. Well, I got the rental income. Gains or losses from the sale of investments, property, plant, equipment, or intangible assets. Well, property, plant, equipment we should know about at this point, right? That's the assets that have long life, used in operations, not intended for resale and depreciate over time. Like what? Like land, buildings, machinery, equipment, trucks, planes, trains, things of those nature. Now, if you're using these in the business, which of course many companies are going to do, that's going to be treated as property, plant, and equipment. But at some point you may sell off some of these items, yeah? And you could have a gain or a loss when you sell off one of these items. Are you in the business of selling land and buildings perhaps? No, of course not. So what you do is you treat that as an other income item. It goes down here, okay? Now we don't know at this point what investments are because we haven't studied that yet, okay? But if you say purchase some Apple stock and you made some money, it would go down here as well, okay? Intangible assets, we haven't studied that yet either, but let's say you purchased a patent and resold it at a profit, that would go down here, okay? So these are other income and expense items. There's some interest income, dividend income, interest expense. So those are some examples. They're not included in our operating income. Yeah? Okay. And that's how it works. There's a multi-step. Why is it a multi-step? Because you have numerous subtotals in arriving at your net income, yeah? Gross profit, deduct operating expenses, arrive at your operating income or loss, that's a very important number, and then add in any of the other income or expense items, and there you have it. So you can trace back to our periodic inventory system video, and you'll find all our new friends, right? The sales, the returns, the discounts, the purchases, purchase returns, discounts, and freight end. You'll find all of them, and this is where they go. So what if you used a perpetual system? Well, your income statement would look a little bit different than this, but just to give you a quick idea, this whole section would be condensed down into one number, cost of goods sold, $741,800. And we'll get to that as we go forward into the inventory chapters. But for now, there it is, multi-step income statement for a company that uses the periodic inventory system. There you have it. And that's it for now. Alrighty? Have fun.